What's going on, guys? Amir Guerami. Happy Friday to everyone. We are looking on episode 15 of the MIU, which is our Mortgage Intelligently University. In these episodes, guys, Ray and I will discuss not specific deals that we're closing or have closed, but provide you more knowledge, almost like a miniature university. Details you should know, facts you should know, things you should consider, and just mortgage and real estate knowledge that'll be helpful to you, whether you're buying a primary residence, investment home, or growing your portfolio. So in today's episode, Ray is going to give us some details about increasing net worth, especially if you're a first-time home buyer. He had a really enlightening conversation with a young lady who is a first-time home buyer. So Ray, give us your knowledge.
Yeah, thanks, Amir. Welcome everyone to our Mortgage Intelligent University. And like Amir said, this is just a simple platform where we can try to educate everyone on using real estate to your advantage. Today's episode is really, we wanted to make it about net worth and how real estate, you can really use real estate to increase your net worth. And this literally just came together from a call I had earlier today. A very close friend of mine, his daughter contacted me this morning, and she's a first-time home buyer, and very sharp, savvy, well-educated. I could tell all that just by speaking on the phone with her. And I could also tell she probably went on ChatGPT or on Google and created a list of questions, standard questions, to ask, and as she was just pretty much going down the line. And we went through all those questions, and I think I answered them all satisfactory. That was to her satisfaction, right? But I think the part that she missed out was about net worth, right? How are you using this real estate, this asset, right? To increase your net worth? And that was the question I asked her. And I think it's something that she probably didn't even think about, especially for the fact that she's planning on purchasing another place, a bigger place, in about 5 years, right? Okay. So her goal was to actually pay down the mortgage, right? Purchase a condo now, and then pay that mortgage down, and then sell that home within the next 5 years and use the equity as a down payment to buy a single family home. So when she sort of enlightened me with what her goal was, I just simply said to her, instead of you aggressively paying down that mortgage, you're a great saver, because she had saved quite a bit for a down payment for this property in a fairly short term. You'll probably be able to save enough money for a down payment on a single family home within the next 5 years. So instead of paying down your mortgage aggressively at a rate on your mortgage, which are probably going to be around 6% or so, right? You take that money, you invest it or put it somewhere, put it in a safe investment. Well, you can probably get at least that amount of return on, compounded over time, right? Of course. And your mortgage interest, of course, is also can potentially be tax deductible, right? So your net interest, although it's 6%, is going to be even probably lower at the end of the day. And then you can turn around and rent out your current property that you're thinking about purchasing. You have someone else basically make your mortgage payments for you, right? And in 15, 20, 30 years, you're going to have an asset that's going to be paid for, that someone else essentially paid for on your behalf. So I think she loved the idea. She understood it. She was very grateful for bringing it up to her, right? And this is just a small example of when you're looking and we're having these conversations with clients, right? Clients aren't necessarily looking at sort of the big picture, right? Which is utilizing this asset to create net worth, right? Down the road. So that was sort of like what, we took away from this call this morning. And it was a great call. She's going to apply and she's going to move forward with this. So that was just an example of how you can use net worth. And you probably come across some situations like that yourself.
Yeah, I was actually going to chime in with you because I coincidentally had a borrower who applied 2-3 weeks ago, his realtor had referred him. Actually, not 2-3 weeks ago, about a week ago, his realtor had put us in touch. This gentleman owns, depending on where you live, guys, some homes that look like townhouses are actually deeded as condos because it allows the builder to build more, have less lot lines and things of this nature. So he had a beautiful townhouse in Loudoun County, Virginia, that he had bought very inexpensively. It's deeded as a condo, but it looks just like a townhouse with garage, you know, his own garage underneath it. He had bought it for about $400,000. It's worth about $680 now. Okay. And he had put 5% down to buy it, right? So he said that all in, when he bought this property 4 or 5 years ago, he put maybe 30,000 into it, right? And it had grown. Talking about net worth, that $30,000 investment has now yielded him a $200,000 increase in his net worth. I mean, that's, talk about compounding money. And you could even do this without a COVID market where things go up 40%. Just pure inflation year after year. The value of your property compounds and compounds and compounds, and you pay the mortgage down, right? So it goes up in value, comes down in mortgage. And he asked me, he's like, what should I do with this? Should I sell this home? Because now his family is bigger. Here we are 5 years later. He's got kids now, and he wants to be, you know, not in a townhouse condo project. He wants to be in a single family home with land for his kids. And he's like, what's your honest opinion? First, the question was whether he qualifies for carrying a rental property and a new home, which he did.
Right.
But I told him, I was like, I wouldn't sell it. Where else can you invest 5%, get a $200,000 gain? And to your point, create an annuity for yourself in the future where someone is paying your mortgage down. I'm sure you hear it all the time on the news. Oh, we're going to run, Social Security's running out of money. I mean, since I've been 20, I've been hearing Social Security is going to run out of money. I don't know if it's going to happen, but if you're a preparer, it's good to have another source of income.
Absolutely.
And these homes, like the young lady in your circumstance or the guy in mine, 20 years from now, that money, someone's going to be paying him a monthly annuity of whatever it is, right? And it's not the same $2,500 they're charging today, because like everything else, inflation, it goes up. So $2,500 today, maybe $4,000 30 years from now.
Let alone the property appreciation as well, right? Exactly. Not just the rental income, but the property also will, you know, appreciate in value, you know, historically, right, over time.
That's right. Yeah. And going to net worth, most people don't understand that on their tax returns, real estate, that's investment property real estate, can be depreciated, right? Which lowers if they filling out their taxes properly, they're reporting everything properly, it also lowers their taxable income. They may not even pay any income taxes on their rent that they're realizing. I mean, it's a trifecta of different ways of lowering your income by having write-offs, but also increasing your net worth at the same time too.
So the beauty of actually from the call earlier today is she's actually self-employed as well, and was using a portion of the home, right, as her business. And like I said, she had all her research done, super bright, and she already knew, right, that she could use that deduction on her tax returns, right, in addition to the mortgage and interest that she can deduct. So, you know, she was looking forward to it, especially when I told her, I was like, look, you know, if you're whoever's doing your taxes, this is a huge tax advantage for you, right? And, you know, try to just explain to her that, you know, purchasing your first home is not an expense. It's your first really major investment, right, that you're making, and you sort of look at it in that capacity as opposed to an expense. So that's pretty much it on my end, Amir. Anything else you want to add to it?
Yeah, I wanted to add a few notes. I always do. I talk a lot, but let me add a few notes to it. One, I love how, you know, Ray and I are in our 50s, or I'm soon to be 50. Ray is above it, but I love talking to I love talking to new home buyers. They do their research, whether it's ChatGPT, just the effort that they take to learn more about it. It's very helpful, right? ChatGPT is a great way to first start, you know, putting things in somewhat of a framework so you could have that discussion. Be open-minded to learning more, because ChatGPT is by far not perfect. You know, who knows, 10 years from now, it'll answer all your questions. But right now, be open to learning after you have your initial discussion. The other thing is, we're not CPAs, we're not tax preparers. So, you know, we're giving you anecdotal advice from what we've seen, both as real estate investors, as mortgage professionals, and things of that nature when it comes to tax returns. So keep that in mind. And as Ray said, this is an amazing tool, not just to put your head down at night and have shelter for your family, but an amazing way to increase your net worth and create a stream of income into your retirement years for you.
I agree.
Yeah. So, guys, this was our episode 15 of the MIU. This should hopefully next week we'll have another topic that we're going to discuss. It's going to be more about the Fed. The Fed is a big topic of, you know, Jerome Powell, President Trump's most recent nominee to the Fed. So it impacts interest rates, or does it? We'll discuss that in detail next week. But thanks in advance for joining us on this one. Thanks, guys.
Yeah,
Bye-bye.